Well, silver was down massively yesterday, about 17% on the day, down to $72 per ounce. And a lot of investors are worried that the price is being actively manipulated lower by the powers that be. So while I would like to do a video addressing the claims of manipulation head on, first we need the information in this video where we explore where the volatility in silver actually comes from. Another 12 sigma hour for silver. Negative 15% silver in an hour happens once every 7 trillion years, okay? The nature of these fake paper slams guarantee the COMEX is failing in March. I don't know about that, I wouldn't bet on it. I also wouldn't bet against it. But anyways, this 7 trillion claim is obviously ridiculous, and someone, Jason, who watched my latest video, said, isn't that assuming a normal distribution? And yes, you're absolutely right. So for anyone who needs a refresher on my latest video, by the way, go watch it. Silver has fat tails. It is not a normal distribution, so the probability of getting an outlier event is very high. So you might see a claim 1 in a trillion or 1 in 7 trillion. It's probably way more common than that. And the numbers bear that out. We also talked about how silver has 2 different pricing regimes. It has a normal regime where returns are kind of normal, and then it has volatile regimes, and we are absolutely in a volatile regime right now. So we are going to get big moves up and down that seem like a 1 in a million, 1 in a billion, 1 in a trillion type event, but we know that they're coming in both directions, and so we shouldn't be surprised by it. But what we didn't talk about in the last video is why that is the case. Where does this volatility come from?
Silver's first source of volatility is its size. Compared to gold, silver's investable market is far smaller in dollar terms. While large quantities of silver exist above ground, most of it is locked into electronics, solar panels, and industrial products that don't respond quickly to price changes. What matters is the portion available for investment, and that pool is limited. Because of this, large capital flows move silver prices dramatically. The same amount of money that barely nudges gold can send silver soaring or crashing. Thin liquidity magnifies every major trade.
So now let's get into 6 primary causes of silver's volatility. The first and most important one is a small, thinly traded investment float. So basically, the silver market is smaller than gold. Very simple. So if we look at the above ground supply of both metals, we see that there's far more silver, right, including these black bars. But anything that's black here is basically non-responsive to price. This is silver that's in your cell phone or in your car or in a solar panel or jewelry. So those things aren't going to respond to price as immediately as investment grade bullion. So the 2 metals, gold and silver, have about the same float. However, it's not the number of ounces that matters, it's the dollar value that it can absorb. And so when we multiply those ounces by today's price, we see that the investable float for gold is far greater than that of silver. It's basically whatever the gold-silver ratio is, that's how much bigger it is. So I think right now it's about 65 times larger. So that means that dollar for dollar, gold can absorb more dollars without moving the price, whereas if you put the same dollar value into silver, you're going to move the price more dramatically. So that's the primary source of volatility in the silver market. So silver has far less capital that can absorb flows, and large orders move the price more quickly. So if you only remember one factor, let it be this one. This is the most important one.
Unlike gold, silver production is largely a byproduct of mining for other metals such as copper, zinc, and nickel. This means silver supply does not respond directly to its own price. Even when silver prices rise sharply, new production can't be turned on quickly. Output depends on decisions made in entirely different markets. This rigidity prevents supply from smoothing out sudden demand shocks. In most commodities, high prices attract new supply and calm volatility. In silver, that mechanism barely works, allowing price spikes and collapses to persist longer than expected.
Number 2, a byproduct supply equals a rigid supply. So silver is primarily mined as a byproduct of other mines: copper, zinc, nickel, even gold. So actually about 2/3 of silver is mined as a byproduct of other mines. So most silver is not from a dedicated silver mine. So what that means is silver production doesn't respond to silver prices. So even as the price of silver goes up, you don't just turn on more silver mines and all of a sudden have more silver to meet demand. It has to come from other metals that takes a longer time, and again, it's a source of volatility because the supply of silver is connected to the prices of so many other metals. So as a result, silver supply can't smooth price shocks, so they're going to stay volatile. The best cure for high prices is high prices, except in silver. Number 3, industrial demand is price inelastic. So most of the silver that is mined is used in industry. It's not used as money or as an investment. Most of it used in industry. And manufacturers buy silver based on its utility, not its price. So if you're going to make a solar panel or a smartphone or whatever it is, you need that silver based on its utility. And if the price of silver doubles or triples or goes to whatever amount, you pretty much have to buy it no matter what. So it doesn't matter how much the price goes up, you're buying it anyway. And silver is such a small percentage of the ingredients in any particular product that it's not going to affect the price of the product too much. So what do manufacturers do? Well, they hedge prices. So they want to make sure that they're not paying too much or selling their silver product for too little. So they have all these different hedges, but that creates a short flow during uncertainty. So sometimes there's selling pressure, even though no one's bearish on the price of silver. So all of these factors combine for price volatility, and this is coming from industrial demand.
Most silver is consumed by industry, not investors. Manufacturers buy silver for its function, not its price. Whether silver is cheap or expensive, it's still required for electronics, medical equipment, and renewable energy technologies. Because silver makes up a small portion of final product costs, demand remains steady even as prices rise. To manage uncertainty, industrial users rely heavily on hedging. These hedges can create selling pressure during turbulent periods, not because demand is weak, but because risk management demands it. This paradox adds another layer of instability to pricing.
Number 4, heavy use of leverage. So futures, not physical, dominate price discovery. So basically, the marginal price of silver, yesterday, today, tomorrow, it's going to be determined by futures prices, not physical flows. And leverage amplifies both upside and downside moves. So many market participants, the majority of them, are using leverage in the futures market. And so when the price of silver goes up a little, it actually goes up a lot. When it goes down a little, it goes down a lot. So we get an amplification effect. So there's already volatility from the factors that we've mentioned, and this volatility creates more volatility. It's also tougher to arbitrage silver than gold because of a lower value density. So if you want to arbitrage $1 million worth of one metal or the other, well, $1 million of gold is actually fairly compact because it's so value dense. But $1 million of silver is quite bulky. It's pretty big, and so it's heavier to transport, it's more expensive, and therefore it is more difficult to arbitrage. So when we get those price separations, those bits of volatility in the silver market, they're going to persist even longer because it's harder to arbitrage them away. And one thing to remember here is that paper products are abundant relative to physical. So in a market that's heavily dominated by futures or paper, it's very easy to create new paper products and use that to manage your price exposure. It's much harder to get the physical element in your hands. So that in itself is not nefarious, it's just a feature of the market.
Silver prices are set primarily in futures markets, not through physical exchange. Leverage dominates price discovery, amplifying every move. Small price changes trigger large gains or losses, which in turn force traders to react. Margin increases can accelerate selling, creating cascading declines. Stop losses and liquidation events form feedback loops where volatility feeds on itself. Adding to this, silver is expensive and bulky to transport, making arbitrage slower and less efficient than in gold. Paper contracts are easy to create, physical silver is not. That imbalance fuels sharper swings.
Number 5, stop losses and margin mechanics. So volatility triggers forced selling. So if the price moves high or low to a certain level, certain participants are going to have to sell in order to maintain margin requirements or to manage their risk. Margin requirements increase forced selling. So as the CME raises their margin requirements, investors have to put up more dollars to cover that percentage, or they have to sell some of their silver so that their position isn't so extended. So those margin increases increase the amount of forced selling that happens, and then we get a cascading snowball effect. So this is an example of volatility creating more volatility. So all that selling causes more volatility. We get a positive feedback loop. And by the way, this dynamic works both ways. It causes big ups that get even bigger and bigger, and it causes big downs that seem to fall through air pockets where there's no bottom in sight. It works both ways. Number 6, silver is both metal and money. So sometimes silver trades like gold and other times it trades like copper. So it has two different trading regimes. So anytime you have two different trading regimes, it doesn't really matter what specifically the two regimes are, but you're bouncing back and forth between them. That's volatility. So silver is a perfect example. Silver also attracts speculators who find gold too slow or too capital intensive. So gold is much slower to reprice, silver moves a lot more quickly. And of course, a lot of people want to get rich quick. They don't want to get rich slowly. So silver is very attractive for those people. Also, silver reprices violently during macro regime shifts, and part of that is because it's so small and thinly traded, and part of it is the other factors we mentioned here.
Silver occupies a unique position. It is both an industrial metal and a monetary asset. At times it trades like gold, responding to currency stress and financial risk. At other moments, it behaves like copper, tied to economic growth and industrial demand. Switching between these roles creates instability. Silver also attracts speculators who find gold too slow or expensive. During macro shifts, rate changes, inflation scares, or currency uncertainty, silver often reprices violently. These moves may look chaotic, but they reflect silver's structure. Volatility isn't a flaw, it's the market's natural state.